Her, The Intelligent Investor, the complete beginner's guide to smart investing. This detailed summary explains Benjamin Graham's timeless investing principles in simple, easy-to-understand language, while keeping all the important concepts from the original book. What this book is really about. Benjamin Graham's The Intelligent Investor isn't about getting rich quick. It's about learning how to avoid losing money in the stock market, grow your wealth safely over time, make investing decisions based on facts, not emotions. Think of it like learning the rules of the road before driving a car. Graham teaches you how to be a safe, smart investor. Part 1. The basics. Every investor needs to know. 1. Investing versus gambling, what Graham calls speculating. Real investing. You carefully research companies. You buy when prices make sense. You plan to hold for years. Example, buying a grocery store because it makes good profits every year. Speculating, gambling. Buying just because a stock is going up, hoping to sell quickly for a profit. Following hot tips without research. Example, buying Bitcoin because everyone says it will keep rising. Key lesson, most people who think they're investing are actually gambling without realizing it. 2. The most important rule, your safety net, margin of safety. Imagine buying a $1,000 laptop for $700. That $300 discount is your safety net if something goes wrong. Graham says always buy stocks with a similar safety net. For stable companies, buy at least 25% below what they're really worth. For risky companies, buy at least 50% below value. How to calculate value, we'll cover that next. 3rd, meet Mr. Market, your crazy business partner. Graham tells a story about Mr. Market. Imagine a partner who offers to buy your share of the business every day. Some days he's super excited and offers high prices. Other days he's depressed and offers ridiculously low prices. Smart investors only deal with Mr. Market when his prices make sense. Everyone else gets tricked by his moods and loses money. Part 2. 2 investing styles. Choose what fits you. Style 1. The careful investor, Graham's defensive investor. Best for people who don't want to spend lots of time researching stocks, prefer steady growth over big risks. Your game plan. 1. Split your money between 50% in safe bonds, like government or high-quality corporate bonds. 50% in a basket of strong, boring companies or an index fund. 2. Pick stocks using Graham's no-stress test. The company has made money for at least 10 years straight, pays regular dividends like a profit paycheck to you, doesn't owe too much money, debt less than half of its value, not too expensive, price less than 15 to 20 times annual earnings. 3. Do this once a year. Check if your 50-50 balance is still correct. Sell a little of what went up, buy more of what went down. This forces you to buy low and sell high automatically. Style 2, the hands-on investor, Graham's enterprising investor. Best for people who can spend 5 to 10 hours per week researching, want to potentially earn higher returns. Your game plan. 1. Look for bargain stocks using these methods. Net stocks. Companies selling for less than the cash and assets they own. Example, if a company has $10 million in cash and only $6 million in debt, but the whole company sells for $3 million, that's a bargain. Bad news bargains. Good companies facing temporary problems. Example, a strong retailer whose stock dropped 40% because of one bad quarter. Spin-offs. When big companies split off smaller parts that investors ignore at first. 2. Always calculate the true value, intrinsic value, by looking at 5 to 10 years of financial reports, estimating how much cash the business can really make, being very conservative in your estimates. 3. Have strict selling rules. Sell when the stock reaches your calculated fair price. Sell if the company's fundamentals get worse. Never fall in love with a stock. Part 3. Avoiding common money mistakes. 1. Why most investors fail. They follow the crowd, buying what's popular. They panic and sell when prices drop. They pay too much in fees to brokers and funds. They think this time is different during bubbles. 2. How to stay out of trouble. Keep it simple. More complex investments usually mean more risk. Check the fees. High fees eat up your returns over time. Diversify. Don't put all your money in one stock or sector. Be patient. Real wealth is built over decades, not months. Part 4. Putting it all together. Modern tools for Graham's methods. Today you can use free stock screeners to find bargain stocks, index funds for the defensive approach, online financial statements, no more library research, sample portfolio ideas. For a defensive investor, $10,000 example, $5,000 in a total bond market fund, $2,500 in an S&P 500 index fund, $2,500 in a dividend stock fund. For an enterprising investor, $3,000 in 3 different net stocks, $3,000 in 2 spin-off opportunities, $2,000 in a stable index fund, $2,000 in bonds for safety. Final thought, what makes an intelligent investor? Graham's most important lesson isn't about math or finance, it's about behavior. The intelligent investor, 1. Thinks of stocks as pieces of real businesses. 2. Only buys when the price is right. 3. Stays calm when others are panicking. 4. Understands that investing is about not losing. More than getting rich quick. This approach has worked for 80+ years because it's based on human nature and math, 2 things that never really change. Next steps. 1. If you're new, start with the defensive approach. 2. Practice calculating simple valuations. 3. Learn to read basic financial statements. 4. Most importantly, begin with small amounts until you're comfortable.